Buenos días, toca mirar ahora los mercados y lo vamos a hacer de la mano de Jay Pelosky, founder and principal of TPW Advisory. Thanks for joining us, Jay.
Thank you.
First of all, I would ask you for a market overview. Which is TPW Advisory market overview?
I believe we are in the beginning of a secular bull market for stocks and commodities, and the beginning of a secular bear market for U.S. Treasuries and long duration debt in general. I also believe that we're very early in the rotation from U.S. equity leadership. The U.S. has been the best performing market for the last decade since the end of the great financial crisis in 2009. I believe we're now switching to non-U.S. equity leadership, as we are also switching from growth to value, and importantly, the momentum factor, which has been, together with growth, the two main drivers to equities for the last decade. That momentum factor is now shifting to value and will support the outperformance of value sectors like financials and energy, etc., as well as parts of the world that represent value, like Europe and Japan and elsewhere. And finally, I'm a big believer in thematic investing as a way to generate outperformance. I think with COVID and the speed at which global intellectual and financial capital came together to generate multiple effective vaccines from around the world in 1/10 of the time it has taken historically, is a model that is now going to shift into other global issues like climate, like cyber, like fintech and crypto. And so I do believe that investing thematically, as well as focusing on non-US markets and on value as opposed to growth, that investing thematically is a way for investors to add value to their portfolios and to help professional investors outperform their benchmarks.
That's really interesting. And besides that, I would like also to ask you about Biden's stimulus plan. How do you think that it will impact the market?
I think that's an excellent question, because one of the things I would want your viewers to understand, your viewers in Spain and elsewhere, is that the U.S. is undergoing a political transition, a transformation away from 40 years of government is bad and we should have small government, to a new mentality that suggests that when issues with COVID, issues with climate, issues like inequality require active government involvement. And the Biden administration is staffed primarily with ex-Obama administration officials. And they recognize that they were too slow and went too small in the stimulus after the great financial crisis. And as a result, we had the rise of populism and all the issues that have happened in the US over the last several years. And so there is a very real sense of change, of political change. The Biden administration wants to go big. So you saw this, the rescue plan, $1.9 trillion. It was passed without any Republican support so that it could be big and fast. And now, within the next month, it's likely that the administration will announce a $3 trillion infrastructure and climate plan that will importantly be paid somewhat by tax hikes, so not purely all deficit financing. But importantly, for your readers to understand, there is now a sense, at least in the government, the Biden administration, that it is the role of government to act big and to act fast when confronted with issues like COVID and climate.
You also mentioned that 3 trillion plan, and we are facing inflation fears. What do you think about that, about those inflation fears in that context of stimulus?
I think that's, again, a very good question, and this is something the markets have been wrestling with. One of the things that's been so impressive to me about financial markets over the last couple of months is that we've been able to kind of pop various bubbles or misconceptions or mispricings in the market. I would suggest the FANG stocks over the last 6 months, people were talking about a bubble that's no longer the case. The GameStop stocks, the Robinhood trading mentality, those are all, most of them are down dramatically. Even the clean energy and thematic, Bitcoin and others have all had at least 30 to 40% pullbacks in this year. And also importantly, the treasury market has moved from 0.9% on the 10-year treasury bond to 1.75% in less than 3 months. And we've been able to do that with the S&P still only 2% off its all-time high. That's actually, I think, quite an impressive performance. And so I do believe that everyone in the markets today understands there's going to be some inflation. It's a question of whether it's going to be transitory and kind of mechanical, just reflecting the fact that a year ago, March, April, May of 2020, we had negative inflation readings, and now March, April, May of 2021, we're going to have positive inflation readings. And so that headline inflation number is going to be bigger than we've seen in a while. I would not be surprised to see headline inflation in the US at 3 or 4, maybe even 5% over the next couple of months. But I believe it will be transitory and it will quickly decline back towards the more normal levels. And importantly, the way the Fed looks at inflation, it's called the core PCE indicator. That doesn't have the same kind of volatility to it. So I don't think that's going to go much above 2 or 2.5%. And I believe the Fed is clear in what it says it wants to do, in that it's going to be data dependent. I think this is also an important issue. The Fed is going to be data dependent and wants to see the actual data of higher inflation, actual data of much lower unemployment. And to me as an investor, I think that's a great thing because it provides clarity. I don't have to wonder about what the Fed is going to do. I know it's going to do something when we see that data. And right now the markets are trying to kind of wrap their head around this idea of a Fed that is going to be data dependent, as opposed to being more proactive and preemptive. The Fed is now going to be reactive, and the markets are wrestling with trying to understand what that means. I think it's positive.
I would also like to know, what do you think about cryptos and Bitcoin? From now, we can also buy cars, Tesla cars with Bitcoin. What do you think about that? Now it's kind of cash in case we want to buy a car.
I think part of that might be Elon Musk having a little bit of fun. He has invested via Tesla in Bitcoin. So it's in Tesla's interest to have Bitcoin go up. And so I think some of this may be just kind of a PR stunt. I think one of the challenges for Bitcoin is it is not really a very user-friendly way of payment, at least not yet. Certainly nothing like credit cards or mobile pay or any of those types of payment systems. I do think Bitcoin is capable of being a store of value in crypto more generally. And I think the pricing of it is going to be dependent on institutional adoption. And we've seen certainly in the US over the last couple of months, many major firms and banks, JP Morgan, Bank of New York, Mellon, Morgan Stanley, others coming out and saying that clients should consider an allocation to Bitcoin, whether it's 1% for JP Morgan. Morgan Stanley suggested 2.5% of a portfolio could be allocated to Bitcoin. And so as that becomes more widely adopted, given that there's a fixed universe of Bitcoin, it's likely to be a supply-demand issue, and the pricing is probably going to go higher. Because at the moment, the vast majority of institutional investment money, pension funds, endowments, etc., do not hold any Bitcoin. And so as they become aware and willing to hold it and own it and custody it, then I think you will see probably continued adoption. And all of this, of course, occurring with tremendous deficits in government spending, which kind of provides a backdrop that is supportive of something that is a store of value.
For sure, we will look at that institutional adoption, which is key. And also one last question. Which will be your advice for investors in terms of industries or companies?
Well, I focus primarily on exchange-traded funds, so not really company-specific, and more thematic and global multi-asset. That's really my focus, is global multi-asset investing using ETFs. And so in that environment, I am overweight equities, underweight bonds, overweight commodities, both clean energy, new energy, as well as old energy. For example, in the US, the major oil ETF has a 5% dividend yield on it. That's very, very appealing. In addition, I also think that the space around cyber is very interesting, as well as the electric vehicle, carbon, uranium. These types of opportunities are different than traditional opportunities, and as I mentioned earlier, I think can provide opportunities. I also think there's a real opportunity in the European equity markets, particularly the European banks. I'm very bullish on the European banks. I also like Japanese equities and parts of the value segments in the United States, financials, energy, miners, things of this nature are appealing at this time, in my opinion.
Thank you, Jay, for your analysis. We got a lot of information for a few questions. Thanks again for joining Negocios. Jay Pelosky, founder and principal of TPW Advisory.
Thank you very much. Have a great day.
Nos dejaba Jay Pelosky ese análisis tan completo de los mercados. Seguiremos echando la mirada al mercado y esta vez con un invitado que ustedes ya conocen, es Eduard Moya, Senior Market Analyst at Oanda. Welcome, Eduard. First of all, I would like to ask you for a market overview. Which is Oanda's market overview?
Well, right now, I think the big theme that markets are kind of viewing right now is just the growth exceptionalism that we're seeing out of the U.S. when compared to Europe. I think right now there has been many headwinds that has been impacting Europe, and we're starting to see that has been weighing on the euro currency. And it's also providing this belief that this reopening theme that we really saw take off in the beginning of the year is, running into a big road bump here, and it's likely to lead to, I think, some instability with markets as far as their risk appetite goes. But I think what you're going to see is that you have the Fed and you have the Biden administration that is still committed to providing so much stimulus, and they're now targeting more infrastructure spending, and I think you're going to see that there's still a very positive backdrop here for for U.S. equities, and I think that should be reflected also globally, probably later in the year when COVID is much more under control in Europe and other parts of emerging markets.
So you mentioned those stimulus, Biden's plan. How do you think that will impact on inflation?
I think there's this belief that you're going to see a surge in inflation over these next few months, and no one's doubting that. The base effects of the shock that we saw from COVID last year is clearly going to be reflected in these upcoming numbers. The economy is in a better position. We are starting to see some signs of pricing pressures, but the Fed is pretty much, content with a little spike higher here. They view it as transitory, so I don't think it's going to be sustained, and I think that's why you're seeing markets kind of still remain overly, optimistic for global equities, and then you're probably going to see that it will take a lot to have runaway inflation, and that you're going to need to have the economy overheating. And right now, there's still, I think, tremendous damage to the labor market. We're seeing a lot of the jobs come back, but it's probably going to take at least a year or two before we're much closer to the Fed's target. And I think that would be when you might be able to say that there could be risks for inflation getting out of control. But right now, I think it's very contained, and markets are pretty convinced with that, and you can take a look at the Treasury yields. I think they're signaling that as well.
We are also expecting GDP numbers. Until then, we saw that durable good orders were a bit disappointing.
Yeah, that was a little surprising, and I was more surprised with the forecast. We had a big winter storm that really disrupted the entire south of the country for over a week, and I think you're probably also going to see that you have to remember January was very robust. So I think inventories were lean. I think companies really just ramped up their purchases in January as well. So I think you're not going to see much of a reaction to this. I mean, obviously, this is going to weigh on the GDP reading for the first quarter, but I think markets are completely convinced that this is just a little blip, and it's not a sign of weakness in the economy. Just I think you're probably going to see that March should bounce back strongly, and all other signs is still, suggesting that I think demand is growing and improving for manufactured goods in the U.S., and that should be positive, I think, as we get deeper into the summer.
Think about this relative calm in bond markets.
Well, I think it was pretty fascinating to see how we saw Treasury yields kind of skyrocket over the prior few weeks, and what we're seeing now is I think there is this belief that the economy is definitely improving. I think we are starting to see that there is some pressures or a little bit of pushback from the Fed that will likely suggest that if Treasury yields were to basically jump above 2% and possibly see that they're trending towards 2.25%, the Fed is going to quickly act. They're going to probably first signal a shift in their Treasury purchases. I think they'll reduce their mortgage-backed security monthly buying and ramp up the $80 billion that they do every month in treasuries. And then if the yield move is starting to accelerate, then they're going to adopt either Operation Twist or they have other tools at their disposal. So I think the markets believe in the Fed. The Fed has been very consistent, and I think that the steepening of the curve will continue to happen. But I think right now the market forces are suggesting that we should start to see a little bit of a stability with where Treasury yields are, and I think that's very positive for risk appetite.
And one last question, as always, which is your advice for investors, either in terms of companies or industries?
Well, I think one of the most interesting divergences that I'm seeing in the markets is just some of the underperforming with Europe. I think that today we had very positive flash PMIs for Germany and the Eurozone, and I think what you're probably going to see is that the reopening of the European economy is going to improve. I think that the third wave, really caught, I think, a lot of people off guard, and I think that we still don't have I think a lot of optimism just yet on the vaccine rollout. But I think that you're probably going to see that just taking a look at production numbers. I think in a couple of months, you're going to see Europe is going to be in much sounder footing, and that's going to probably see investors want to jump on that trade. So I think euro dollar is probably maybe there's just one last major, I think, push lower. But in the end, I think that you're going to see a much stronger euro when we're talking closer to the winter time. And I think European stocks are also going to rally pretty significantly as well. So I'm a little bit more upbeat on Europe than most. And I think that now is the time that you might want to consider scaling in, and hopefully Europe does have a much improved second half of the year, and that should be very positive for that trade.
Thanks for your recommendations, also for helping us with your analysis. Eduard Moya, Senior Market Analyst at Oanda, thanks for joining Negocios once again.
Thank you for having me.
Nos quedamos con esas recomendaciones de inversión. También nos quedamos con esas dos miradas al mercado tan útiles y con tanta información por parte de nuestros analistas internacionales.